welcome to the Wealth Wisdom Financial Podcast. We've got an amazing treat today. We're having a conversation with one of our good friends, Matt Shanlian. I'll tell you about him in a second. But we're talking about managing equity, and we're rounding out our series this month for real estate investors. And one of the things that real estate investors often use when they're managing their equity is loans, mortgages. We talked a little bit in our last episode of how that can go wrong. Today, we're going to talk about how that can go right and certain myths that you need to rethink potentially as a real estate investor. And the reason we chose Matt as the person to interview on this topic is he is the vice president at Cross Country Mortgage. He lives in Worcester, Ohio, and we personally have worked with him and people from his team to have our own mortgage and to send our folks to him all the time. And we do it for a very specific reason. He, as he will share in the episode, the philosophy at his mortgage brokering firm is rooted in financial strategies and financial planning. And they specifically partner with folks like us to make sure that when someone has created a financial plan, they have a strategy together, when they go to get the mortgage to match that mortgage person, the guy at the bank, whoever it is, isn't going to try to wreck the plan and do something that's contrary to what has been already set up. So they love valuing that people have a plan for their equity, the equity within their homes that they own, whether they be single family, multifamily, or what have you, and that they're able to carry forward that plan throughout their life. So Matt is a great resource there. Him, his wife, they have 3 kids, and they love all things Cleveland sports, and he loves to serve in his local church. We'll put the full bio as well as Matt's contact information in the description, and get ready. We've got some really big myths that we're going to bust for real estate investors. But if you're not a real estate investor, you might really value this conversation to get a sneak peek into it and just think about managing the equity in your home wisely, maybe even thinking of it how a real estate investor would. You know how we think about personal finance as a business, we can think of home equity as a real estate investment. So look forward to this conversation. It's going to be really great. And thank you so much for checking out the Wealth Wisdom Financial Podcast. If this is your first time, we believe when conventional financial thinking doesn't get you where you want to go, you need wealth wisdom. Please hit that subscribe button and give us a like, a comment below. We're hoping to do more conversations about mortgages and home equity in the future. So we invite your questions in the comments of this video if you're watching on YouTube, or if you're checking us out on the podcast platforms, send us a quick heads up. Let us know what you'd like to see in the future, or go on over to the YouTube universe, find this video there, and comment as well. Okay, without further ado, here's Matt. Hey, thanks so much for being here, Matt. Welcome to the Wealth Wisdom Financial Podcast. We're excited to have you here. Let's jump right in. People heard your bio. They know a little bit about what to expect, but tell us the backstory. What brought you into the mortgage industry?
Yeah, I mean, it's the age-old tale. My father actually has been in the financial services industry since the early 80s, as an advisor and manager of an advisement company. And then he started a mortgage company in the late 90s, and it ended up being his passion. And when I got out of college in 2008, it was a great time to have a finance degree. And not a lot of people were hiring, but my dad said, "Hey, you can answer phones for not a lot of money." And I took that. It was better than the other options that I had. And so kind of started thinking, this will be good for a time and I'll figure something out. And lo and behold, I really grew to love it over the years and still do. And we just have this really unique niche in our mortgage industry and who we help and the relationships we've had. So that's kind of how I started in 2008. It's 15 years ago. It doesn't feel that long, but it's been a really great ride so far working with people like y'all.
Well, what I've heard too is Your dad was very familiar with the banking yourself system
Mhm.
and's been around with the banking yourself system and Pamela Yellen and uh, all the people there that it's just been really a great alignment. And you don't just say, "Hey, do a mortgage," but you're like, "How does it fit within the other factors?" And that's what I love about what you guys do. It's very different than let's just let's just qualify you for the best quote unquote mortgage,
Yeah.
but how does it play to everything else? And that's
Yeah.
why we have mortgages with you guys and why we recommend you guys to so many of our
Yeah. To color in the lines a little bit too, when my father started the mortgage company, the reason he started the mortgage kind of almost as a side business was a lot of his advisors and a lot of the people that he was managing were, their clients would come to them with questions about mortgages. And, over time he thought, well, we're just giving these referrals away and to a bank, and sometimes the bank doesn't do what we say, or
clients.
they convince them of something different. And then, back in the 90s, banks started adding financial services, and he more or less started this as like a little side business to his main company. And over time really found out like that how important it is to partner with the financial professional to protect their clients, to protect the financial plan. Because like I said, I always tell people I love the mortgage industry. I love everybody in it. There's some bad actors like in any other industry. But a lot of times what happens in this transaction that blows things up is not malice, like a loan officer's going rogue and trying to ruin somebody's life. It's ignorance. They don't know the rest of the financial plan. They don't
Yep.
understand bank on yourself. They don't understand the power of permanent insurance and how to fund that correctly. And they're in their little silo saying, "Boy, this 15-year rate is pretty good looking today. Boy, let's do that. You can make the payment. You qualify. Here's your debt ratio," not knowing that all those monies are actually already spoken for in the budget. And so
Yep.
that's one of the things that we want to be always cognizant of when we have a relationship with an advisor and their client is what's the total picture, whether we're talking investments, first home purchases, home builds, or building that bank on yourself policy to be from the beginning. We got to know a little bit more than the run of the mill loan officer or mortgage company.
Yeah.
Yeah, I love that. And we're going to have you back on to talk more about how mortgages fit into a larger financial strategy and a comprehensive financial plan. Today, we're focused mostly on real estate investors and
Mhm.
busting some of the myths that people believe about managing their equity as they're becoming real estate investors or growing their real estate portfolio. And so, one big myth that's out there is as people are going after their financial freedom dreams through real estate, they realize they're going to have to acquire a lot of properties, 20, 30 plus.
Mhm.
And sometimes they'll shift from single family to duplex because they realize that they can only have 10 mortgages at one time, or 10 qualified mortgages, I think is what they're called
Wait,
at
wait.
one
I
time.
thought I thought Monopoly, and when you played the Monopoly game, that you could actually have many.
Well, we're in real life now, not a
Yeah.
board game.
Oh,
So, talk to us about strategies that real estate investors could use to manage their equity when they're owning many multiple properties.
Great. That's a great question. And boy, there's so many avenues we can go down through answering this. I mean, most importantly, understanding there's two things. If you're in real estate investment and you own a couple homes, and you've done the mortgage process before, um, and the most common um, issue I would say with investors is uh, source of funds,
mm,
funding sources, just having cash. Hey, I know how to find the right house. I'm handy maybe, or I have a company that can help me get it in proper shape to get it rented. Um, but the issue is loans and cash to put down. And so uh, conventionally speaking, we talk about qualified mortgages. That's your conventional, your Fannie, your Freddie loans. They're only going to allow you to have 10 loans in your own name at any given time. And that's going to include any vacation homes or primary residences. And the also thing with Fannie and Freddie is they make you close that loan in your personal name. And as we know, most investors that have, like you said, 20 or 30 doors, We call them doors, not houses, because, duplex, triplex, every door is a rent. Hopefully, sometimes one door has multiple rents. That's more Airbnb style, but and so we want to make sure that we understand the difference between a qualified mortgage and a non-qualified mortgage, because qualified mortgages, they're generally going to have the lowest rate, but they're going to be pretty inflexible. What I mean by that is you can only have 10 of them. You got to close in your own name. So there's some liability things there. And I know sometimes people have said, well, you can close it and put it in the LLC. And I would never advise that because that does break your contract. The thing about non-qualified mortgages, one of the cons is your rate's going to be a little higher. There's still 30-year fixes. They're not always variable, but they'll let you close in an LLC, a lot more flexibility. A lot of times, a lot less paperwork. Since it's non-qualified, the investor kind of can create a profile and not be as persnickety or be as stringent on income. There's programs out there that doesn't even bring income into the equation that are really exciting. And so just kind of knowing the playing field when you're an investor is very important, because that old wisdom of you can only have 10 and you have to figure out how to kind of move that slide ruler up and down for the 10 to go get your next one. There's other options out there for investors that really allow you to kind of scale up.
Yeah, love that.
I like that too. Is you were saying like the mortgages, and some people think, oh, they're all the same. Just like they think about that with life insurance. Oh, they're all the same. It only works this way, and we're coming in saying, actually, there's other ways. There's other ways to go about it, and to have a person or team that understands the playing field. I mean, we're still learning on the mortgage space. Yeah.
Mhm.
Like literally, I'm no mortgage expert. That's why you're our friend.
Yep.
So then we can bring in somebody and say, oh yeah, this guy has 9.5 mortgages, and trying to figure out what the heck to do. And I'm learning that along the way. I was like, I didn't even know this was a problem. And as we grow, we're meeting more and more investors who are growing like the Monopoly game and saying, I need to trade in my single plexes for double plexes and buy a hotel. All this is happening regularly.
Well, and so then we also hear when people are trying to build their cash flow, they hit this limit of 10 mortgages. They're like, okay, I'm just going to try to pay off my mortgages as quickly as possible. It helps me qualify for the next mortgage, but it also helps me have more cash flow so I get my freedom number faster. What's wrong with paying extra on a mortgage?
Well, I would say that I hate to say it's wrong. I just don't think it's the best thing. I think there's way better places to put that money. And one of the things I always like to say especially with investors, and if you're an investor, you're listening, I know I'm preaching to the choir here, but like, it's kind of addictive. You get that one property and it's cash flowing and it works. Well, I want the next one. I want the next one. And a lot of times that's how people get themselves in trouble, is they have success a couple times and then they just think every house they want to buy is going to work, and a little bit of a lack of a plan there. And so using their home equity kind of reactionarily, like, ooh, this house is a little bit more of a money pit than the next house, and it can slow down their ability to buy in the future, because they were either lopping large extra payments into the mortgage to pay off, or getting like equity lines to use for the next property. So in regards to the bank on yourself, especially with permanent insurance and how you all utilize it, and the ability to loan against and have that money in and out, paying extra on your mortgage, I always tell people it's like a qualified account. And we always use the qualified account term for like a 401k. The reason I call it a qualified account is if you pay your equity down quickly and you pay your house off, to get it out, you got to qualify for it. And especially if you're an investor with a lot of properties and maybe some LLCs, you're trying to avoid the tax man as much as possible. So you're going to write your income down a lot, and what you're allowed to. And I encourage that. Every year you pay your taxes, but the less income you show, the less house equity you're going to qualify for. So why would you rush to pay off an account that you have to ask me to get the money back from? And also, by the way, I can say yes or no. I can say how much.
Yep.
You say, hey, I have this $200,000 house. I don't own anything. I want to get $50,000. I can say, you don't qualify. No, nope, sorry. Or I could say, hey, your rate's 8%, or you can only get 30,000, or, I dictate the terms. And when I say me, I'm speaking as a mortgage lender. And so it may sound crazy to you for a mortgage lender to be like, don't give me the money. When you understand the bank and yourself policies and the philosophy, it's like you realize that extra cash flow should be going to those policies because, and I know I'm being the insurance agent now, I shouldn't be, but when you ask your policy holder, can I have X amount of dollars, and there's that in there in cash value, can they say no?
Nope.
I can say no. Sometimes I don't want to say no. I don't like saying no. You go broke saying no, in my industry. But if you don't qualify, you can't have it. So like we say, like, why would you rush to pay this equity off? And with values where they're at and how they're escalating, you're building equity without doing anything. The market is generating home equity in your house on an annual basis. It's just not the best place to be putting your extra funds.
Yeah. What I think about too is the real estate investors who are headed toward a freedom number, they have a W-2 9 to 5 kind of job right now, and they're trying to build their portfolio so they can leave that job. That significantly impacts their ability to then do those refinances or get new mortgages when they don't have that W-2 anymore, no matter how much income they have. Kind of a side rail here, there are some ways to get some non-qualified mortgages that are based not on someone's income, but on the rents being received from the property.
Mhm.
How does that impact how we might think about this idea of paying more to the banks?
Yeah. So when we talk about the non-QM or the non-qualified mortgage space, those loans, especially over the last few years, have really um, evolved in a real positive way. With conventional rates rising and these kind of rates kind of stagnating, the difference has been less and less as far as a rate spectrum. But one of the common programs is called a DSCR loan. And a DSCR loan, very simply put, is a mortgage note that how you qualify for is you have a minimum down payment. Generally, it's 20% on an investment, a minimum credit score, generally depending on the investors between 660 and 680. And as long as the house or condo or duplex or whatever you're financing, as long as it's residential, we don't do apartment complexes, of course. So up to 5 units, as long as it cash flows 125% of the payment. So real easy math. Mortgage payment's $1,000. You're collecting $1,250 of rent. Hey, we have 125% space. As long as we can prove that with either leases or average rents in the area, we don't bring into your personal finances. Great. Especially if you've left that W-2 job and maybe you've just left it. And so you don't have a tax return filed, or maybe just one tax return filed with this new venture. Boy, that kind of gap first 2 years when you take your foot off the boat of W-2 income into full entrepreneurship, you can't really prove a lot of income. So this is a great product there. The other thing that's great about it is you can close it in an LLC. You don't have to close it in your name, so you can fully protect it. And it's the norm for this product. It's not an ask and I hope. And so it's really designed specifically for a savvy investor that understands, yes, my rate's going to be a little elevated, but my access to capital, generally speaking, on an investment property for a conventional, you want to put 25% down. We can put a little bit less down here. And you can get in and out of those loan processes quicker because we're not bringing income in, and you can get to that property quicker to get it in your portfolio. So really, really great product.
Awesome. Thanks for sharing about that. And we wouldn't want to depend on the ability to get one of those and pay off a mortgage more quickly because it's not guaranteed that you can get that even, right? If you have a vacancy for a while or something like that, it
Sure.
could be hard, or if your credit score goes down or something like that.
Yeah. And think about even the vacancy. We didn't talk about that. You own a bunch of properties and maybe you have 3 or 4 go vacant, and that can kind of, you own 10 properties and 3 of them fall out of lease and you're still waiting for tenants, and that can kind of crunch cash flow for a few months. And all that extra money that you may have been lopping into that mortgage payment, you can't go get back. But if you put all that extra profit into your policy, your bank on yourself policy, you got a bridge, you know, and I can't give, you know, those hypothetical bridges. And so we want to, and also like the tax deductibility of your interest and all that stuff. We can get real deep and nerdy about that. But having paid off investment properties have very little value other than cash flow. And if you're diverting that money already from the beginning to a policy, you're going to have a lot more flexibility anyway.
Well said.
I mean, I like, again, hearing some of the stuff that you shared and experiencing it myself as I've worked with people who want to, you know, do the fire thing and leave their W-2 and start a real estate. They want to get into real estate. I remember trying to qualify for a mortgage and starting our business and having plenty of money, but not able to qualify because I didn't have income yet from the new business, right? And that's a challenge that people don't know that's coming as they launch into these things. And as we are, the space in real estate investing is hot. And people are like, oh, I want to get my freedom number. So I'm going to be and I hear this all the time. And that's, again, why having the conversations with us and you to be able to figure out and say, oh, what, there's this thing that you didn't know about this? How come your mortgage guy didn't tell you? You know, like those things are super, super helpful. And I'm just keep learning myself.
And those missed opportunities are huge, especially in the investor space. And one of the things that we like to give people as pep talks, either if they're just entering in or maybe they have one property, is, you know, more than anything with housing and investor space stuff, like you have to have a plan. You need to be disciplined in that plan. I get that houses kind of come up at random and the excitement of the chase or the buy or the find is big. But you get too excitable, emotional, like that one property can really tip. And so really, you know, if you're in the space or you want to be bigger in the space or start in the space, the first thing you need to have a plan for is the finances part. And not just how to buy the house, but your financial household, quote, as a whole, and how it's going to support this venture. Not just saying, hey, I got 30 grand in the bank, let's go try to find one and start. That's great. 30 grand in the bank is fine. But there's better places for the money to be in the bank, especially banking yourself. So like there's all of these things that I want to tell people or encourage them to pause, and speak to a financial professional, put a plan together and say, hey, my goal, write it down, is to tone 20 houses. And okay, how do we get there? Not by just driving around and getting lucky. You'll never get there. But if you put a plan together and you stick to it and you understand the products available, I have a client of ours that owns 300 homes in one county in Ohio. They're diligent. They have 2 people and they're great at it, but they're smart and they're patient. They may buy 10 homes in a month. They may not buy a home for 6 months, but they know how to do it. And so planning and putting a plan together and then implementing it is very important for you to go from 2 to 5, 5 to 10, 10 to 30. There's these big jumps. It feels like people in 1 or 2, they're stuck. But you see people that all of a sudden triple their portfolio in a 2-year period because they finally kind of found the rhythm of how to fund these things.
That's some good wealth wisdom there, to have the plan and to be patient with the plan, work it through. I love to also remind people it's not about the houses. There's some kind of why or some kind of thing that's important to you that these houses allow you to do, that this rental income, the syndications, whatever kind of real estate flavor you're in, you got to know that why too. And too many people just jump to, I'm going to build the income and then I'm going to figure out my why. It's like, no, use that income as the why as the fuel to get to that place, to build the income, and it'll help you make better choices probably too as you go. Rapid fire question here. This might be a great topic for the future, but everybody's talking about rates going up. Actually, the day we're recording this, the Fed just raised rates.
Again.
When this airs, who knows what's going to be happening? The smart people think about what happens the next time rates go down, so we can be prepared. If they're going up right now, they're eventually going to probably come down. What's 1 or 2 ways we could
we get this question a lot for people, like, we have clients and just honestly people in our communities, like you want to quote the term time the market. You want to time it right. And, if anybody knew how to do that, they'd be really good at this. There'd be one loan officer that does all the loans if they could time it perfect. And so anecdotally for this, especially now, like high interest rates, yeah, we have high rates. And you say, maybe I'll wait till rates are in the fives. That I like. 5 is lower than 6. So that's good, right? Sure, on paper. But what you have to understand is mathematically, about 40% of homeowners right now have a mortgage. Okay. Excuse me. I'm sorry. 40% of homeowners right now have a paid off mortgage. So 60% of the homeowners have a mortgage. Of those 60%, 85% of them have a mortgage rate under 4%. Okay. So putting their house up for sale, there's not a great incentive unless they're moving for a job or retiring, downsizing, but there isn't an incentive there. So there's a lot of buyers. There's not a lot of inventory. If rates were to drop a whole point or point and a half and the average rate goes to 5%, all that's going to do is bring more buyers into the market because houses are cheaper.
Yep.
Because the payment's going to be lower because of the rate. Well, inversely, more buyers means more bidders. More bidders means higher purchase prices. And so that $200,000 investment property that you can get today at 7.5% maybe, that's going to cost you $230,000 if rates are at 6 on an investment property. And so we try to pay less. I mean, rate is important, pay less important to rate, but more important to the marketplace, and understand, like you even see our friend on the radio in Tennessee, Mr. put 20% down for a long time. And then a mortgage company started giving him some money, and he started going, well, you can put 10% down now, because he wanted to sell more products. But also, like, it didn't make sense because home values over the last 5 years have risen so quickly. Being two people in fixed income, to be able to, if a home value appreciates 10%, that means that 20% payment, you have to save an extra $5,000, $10,000, $20,000 a year to get to that 20% marker. People would never be able to catch. And so he's revised this strategy, and rightfully so. But I think he waited till a mortgage company gave him money to do that. But just understanding that we always say you marry the property, you date the rate. If it's the right property and it cash flows, especially in the investor space, if rates do come down, let's take advantage of it. If rates never come down, you got the best rate you could get. But waiting to get the right property at the right time and at the right exact rate, hey, that might happen for you, but that's going to be a unicorn. Find the property, make sure cash flows at a bad case scenario, and if it gets better, we're just going to improve it. And that equity you earn over that time period, we're going to rip that out too and help you get it into a bank and yourself policy so you have control over it, not me in the bank.
I think that's wisdom right there, not just having knowledge of the rate or the other thing, but we're saying what's the best decision and building in some wisdom and having a full picture, right, of that, but not just saying let's just keep gathering information and wait, but making a good decision with the data we have and knowing that we don't know what the future will be, or what the Fed or anything will happen.
Yeah.
Okay, that last question, really easy. We've even heard very recently someone tell a client, you cannot use cash value from or a policy loan from your cash value whole life insurance policy for a down payment. What do you say about that?
Goes back to the comment I had earlier. A lot of people not understanding what permanent insurance does or is or its uses. From my industry side, that ignorance has led to that answer. And so, anytime a loan officer hears loan, they think, oh, you went to a bank and you asked them for money you don't have and say, I'll pay you back over time. And we all know in a life insurance policy, number one thing, you can't, if you have $100,000 in cash value, you can't go to your policy, correct me if I'm wrong, and say, hey, insurance company A, I have $100,000 in cash value. Will you give me $400,000, please? Can't do that, right? Unless that's changed. Okay.
Right.
So when you're borrowing against your policy, you're borrowing your own money. And similar to if you do a 401k loan, which I don't prescribe at all or tell people to do at all. But in lending, if you do a 401k loan, I don't have to show any terms or payment back because you're borrowing your own money at a tax rate.
Yeah.
Same with a life insurance policy, because you could take the $50,000 out and never give it back. And at a certain point, they just reduce your value and your death benefit against it. And so a lot of loan officers just don't know that. And so when somebody says, hey, I'm taking a loan against a life insurance policy for my down payment, they'll say, well, you can't, like, I can't use a credit card as a down payment method. And that's where their mind goes. And that's completely wrong. And I can literally take you right to the guideline in the Fannie, Freddie, and Ginnie, which is FHA and VA guidebooks that show that guideline. It's just that they don't come across it very often. And so I helped a client of a friend of yours out. I didn't even get the loan. I just kind of told the loan officer, like, hey, you're going to blow this if you don't just, here's the guideline. They're fine. And it ended up helping them close their loan, where he was a little bit in the weeds on how to do it. Ultimately, understanding the policy, understanding how banking yourself works is our biggest advantage, because I don't have a Matt Shanlian mortgage or a cross country investor mortgage that's different than anybody else. But how to utilize it, how to apply it, and how to leverage the rest of your finances is where our value comes in.
Yeah, I literally was talking to, when we started our buying our office, talking to a mortgage guy, told him what we were going to do and plans on this, and he's like, I've never heard of that before. I'm like, how long have you been doing this? I was like, 20 years. I was like, for real? And we used our policy to basically become part of our mortgage. Like, we're paying ourselves back in that regard. And people just don't know what they don't know. And the way I kind of think about with our policy, kind of like when we borrow money against our policy, if you're the mortgage guy, but I'm like, you do this when you buy a house and you take equity from your house to go buy something. It's called the HELOC. Isn't that kind of similar, except you're the house? I mean, like, literally, that's the difference. Instead of it being a physical house, you're the house. And yeah, I don't know if that's right or wrong. But
Yeah, no, I mean, the only difference that I would say, and that's just, following along your theory, the only difference you would say is that, the HELOC is going to have a term and an end date. And the beauty of banking yourself. Now, we don't want to, I'm going to say I'm not the financial advisors. No, as much as passion I have for this product and you guys and everything, the philosophy, we want to pay the loan back.
Yeah. Yep.
I mean, we don't want to just take money, start a policy and loan against it and just let it die and lapse.
Yep.
But we don't have to do it immediately. We don't have to do it quickly. We can do it. Hey, I get an annual bonus at work. Maybe that's how you pay your loan back. You just get a lump sum every November, and 4 Novembers later, you've paid it back, and you really haven't changed your cash flow. That's the value there, because the home equity line of credit, the day you sign it, has a maturity date. Yep. And so you got to perform to that date, or, and the other thing I always tell people too, and let's say the worst thing happens and you lose your job, but you are smart enough to be putting your money in your banking yourself policy. That's your bridge to the next job. That's your help through to keep your house. If you take all the money out of the policy, the only thing that happens is the policy lapses, right?
Yep.
The insurance company can't say, and your credit stinks, and this is happening to you, and you can't buy a car now. But if you lapse on your mortgage, can't pay that.
Done.
Everything's affected in your lifestyle. So why, like I said, why would you put extra money to a place that, and it's me, I always joke, if you guys have seen The Big Short, you've seen that movie?
Yeah.
So like Ryan Gosling's character, which is a hilarious character, there's a scene there where like, you work at the bank. Why are you telling us this? He's like, I work at the bank. I don't work for the bank. And that's kind of our philosophy with this, is like, it may be advantageous for a bigger down payment and a better risk position for cross-country mortgage. But understanding banking yourself, like understand that your home equity should not be growing exponentially because you're forcing it. Let it grow naturally through the market and put every single dollar into your bank on yourself policy because you have control. And if you give it to me, I can't say no, but then I control it and I control the terms to give it back to you. And we've belabored this point enough, but I'm just saying, don't do it. And we should we should get a website that says, don't give me the money.com or something. Like we should almost market to it because I want people to understand that philosophy so much. Like, don't build this equity through extra payments. It just, there's no value in it.
I'm going to make a movie reference too, since you did. It's from the latest Top Gun movie. We finally watched it recently. And the whole idea, it's not the plane, it's the pilot. It's not the mortgage. It's not conventional, traditional, qualified, non-qualified, like whatever. It's the mortgage broker. It's not the life insurance. It's the professional. Now, within some reason, right? You still want a good plane, like a pilot with a junker is not worth anything. But what I love about how your office works is the mortgage brokers there don't work on commission. And so they get to choose what's right and going to work best for the client based on what's available, how it fits into their comprehensive financial strategy, all of that, not based on how they're going to put food on the table that night. So I hope people will connect with you, Matt, and with your team there at Cross Country Mortgage in Worcester, Ohio. Woo woo, Ohio in the house. How do people connect with you? What's the best way for them to reach out to find out
give
more?
you 2 bits. One of the things too is if you're watching from not Ohio, we are licensed in all 50 states. I'm personally licensed in about 37. It's a lot. It's it's a lot of classes that I have to take. And so if you live in Ohio and have an investment in Indiana or Florida, like we can be that one-stop shop as the investor side of things. To get the hold of me, just my full name. You see Matthew. I can see it on the bottom of my screen if that's what it's going to show in the recording. Just put a period in between my first and second name, Matthew.Shanlian, and it's at ccm.com. Matthew.Shanlian at ccm.com. Our office number is 866-888-7902. That's 866-888-7902. Sabrina will pick up. Just ask for me. And if I'm out of the office, we have a group of over 16 loan officers that kind of handle this business nationwide. So you get to know them. But we really love to download, especially if we're talking to an investor. It's not just like, you want to buy a house? Here's your rate. The first question is, how many you own? How many you want to own? What's the plan?
Yep.
And that is going to codify what we're going to do from how to, detail out from there. We don't want to be transactional. We want to be relational. I have I have clients that have 10 houses, 20 houses, 300 houses. Their needs and wants are different. And so we shape the loans to fit them. And so, we're just mortgage guys and gals, and we just love to talk investor side of things. Love the banking yourself. I mean, for 15 years, we've been a strategic partner, been in all the meetings, spoken all the trainings. We just have enjoyed that partnership to no end. So I just appreciate you guys having me on.
Well, and we will be having you on more because we just kind of touched the surface, guys. So as you guys are listening, again, find Matt. But here's the thing. The real estate world is always changing. The interest rates are always changing. What was good and good advice maybe 20 years ago is different. And so you want to have somebody that knows those and is keeping abreast, because God knows it's hard to keep track of what the heck's going on in the money world. And so we're going to be doing more videos. And if you like this, put a comment there. And if you listen to this video and you reach out to Matt and tell him that you heard about it from Wealth Wisdom Financial, and tell people that you want to hear more from Matt, that you want to learn more. And if there's a topic that you want us to address, let us know, because we will address it if that makes sense for you.
And of course, we'll put Matt's information in the description of this video, or if you're watching or listening on a podcast, in the show notes, so that you can reach out to him right away. Don't hesitate, reach out, get something scheduled, and move your financial future forward.
Thanks for
so
having me
much,
on.
Matt.
Can't wait till the next one.